When a boring stock drops, most people look away. Add insightful value, that's when we lean in, because sometimes the companies with the least hype have the most potential. Today we're breaking down Bunzl. Yes, Bunzl. A quiet global powerhouse whose stock is trading unusually low right now. And no, this isn't financial advice. It's an educational review meant to help you think deeper about overlooked businesses. Hit like, subscribe, and let's unpack what's really happening here. Bunzl might not be a household name, but its products are in almost every industry. From packaging and hygiene supplies to safety gear and disposable food containers, Bunzl is the behind-the-scenes supplier for sectors like healthcare, retail, and food service. They don't make flashy consumer goods. They move the essentials that keep businesses running. Right now, their stock is down from its previous highs, which naturally raises eyebrows. So what's the story? In 2023, revenue grew modestly, with full-year sales reaching about £11.8 billion. That's not bad, especially in a tough economic environment. Gross margins stayed strong, hovering around 25%, and their operating margin remained stable thanks to solid cost management. Earnings have been flat to slightly down recently, mostly due to inflationary pressure and a return to pre-pandemic demand levels in some segments. However, Bunzl has managed to offset a lot of that by acquiring smaller distributors, a strategy they've been using for years to grow quietly and steadily. What about dividends? Bunzl has increased its dividend every year for over 3 decades. That's not a typo. They're one of those rare dividend growers that just keeps delivering. The current yield is modest, around 2.3%, but the consistency is what matters here. That reliability is a big draw for long-term investors looking for stability in uncertain times. So, why is the stock price low? A mix of things. Market rotation away from defensive names, investor concerns about slowing growth, and uncertainty around global demand in 2025. Add in some weaker sentiment across the packaging and logistics sectors, and you get a price dip, even when fundamentals haven't cratered. The risks? Bunzl operates in a fragmented, low-margin industry. Their success depends on tight operational efficiency and continued acquisition discipline. If integration of new acquisitions slows down or global costs spike again, margins could suffer. Plus, with interest rates still high, financing new deals becomes more expensive. On the flip side, their business model is incredibly resilient. They serve thousands of customers across dozens of countries with no major client concentration. That means stability. Their decentralized structure gives them agility in local markets while benefiting from global scale. If inflation cools and volume picks up again, Bunzl could easily rebound, especially if the market starts to favor safety and reliability. Is a recovery around the corner? It might not be dramatic, but steady is Bunzl's thing. This is the kind of company that slowly earns back investor trust and attention, not with hype, but with consistent results. At Insightful Value, we specialize in uncovering companies like Bunzl, the ones hiding in plain sight. Our analysis strips out the noise and focuses on what really matters. Whether you're a new investor or a seasoned one, we help you understand the deeper value behind the numbers. For more insights like this, visit insightfulvalue.com. And if you found this breakdown useful, hit that like button, subscribe to the channel, and stay ahead of the noise.